So my name's Richard Betts. I'm the publisher and look after all of the content really for Real Asset Media. We publish, amongst other things, Real Asset Impact there, which is focused on ESG, social impact strategies, that kind of topic, purpose-driven investment, and Real Asset Insight, which looks at the sort of wider market, but we're looking particularly at some of the research, the analysis, the themes, the kind of things that will be driving the market. So in this discussion, we'll be looking at what we're seeing in the market, but also where we think the market is going to be heading. And it's deliberately a small and intimate group so that then, if there's questions you've got, please just ask them and we will try our best to answer those, or at least give some insights into it in terms of what we're saying. Thanks also to everybody who's joining us as part of the on-demand event program here live from EXPO Real. The session is going to start just with a quick overview and a catch up on the market here. And Sally Bruer from Cushman and Wakefield is just going to give us a quick kind of 5 minutes on some of the topics here that we'll then drill down into a bit more in the presentation. Let's pick that up, Sally. Thanks very much.
So I'm going to very quickly just talk about some of the market dynamics, which will then spur the conversation with our panel. And to set the scene, I think it's a story of two halves, perhaps. So on the left-hand side here, we have our investment volumes for logistics and industrial across Europe. The market reached a peak about a year and a half ago. At the end of Q1 2022, investment volumes totaled a record high of almost 80 billion euros. And that was broadly consistent across all geographies, seeing a record high in terms of investment into logistics and industrial. Where we are now is a slightly different story, and this is the volume to Q2. The Q3 numbers have only just settling, so give us some time, but we are expecting that perhaps it will be a slightly better quarter than it was in Q1 this year, and certainly the back end of last year. But to the end of Q2, a year later from where we were at the peak of the market about halved to about 40 billion, just shy of 40 billion euros in the end of 2023, Q2 2023. We have started to see that volume picking up on a quarter-on-quarter basis, and this is on a rolling 4-quarter basis. We've seen that picking up slightly on quarter by quarter, and we expect that Q3 might start to show some improvement. And that is a story of the time we live in now. And I think we'll be talking about pricing, and I don't want to labor too much about the volumes, because that tells us about the stasis in the market for very good reasons around the pricing. And that, I think, if I flip forward, on the right-hand side, this shows the acquiring countries of different, the cross-border investment from different acquiring countries. And we have seen a continued focus from major North American investors, particularly from America and Canada, but also cross-border within Europe, and particularly from the UK investors, German investors, but not exclusively. There are obviously sources of capital coming from across the spectrum, and we're seeing parts of the market growing, particularly from the Far East, where we're seeing more money coming from Singapore, Korea, and other parts of the Far East. I wanted to talk a little bit about pricing, because it will come as no surprise to everybody when we look at this curve or we look at this chart on the left-hand side. And this chart, or the right-hand side, this chart shows the yield difference for just the primest locations between Q1 2022, when we reached the peak of pricing, to where we were at the end of Q2 2023. And I would suggest also, as I said, we're settling the dust on our data collection for Q3. We are expecting that many of these yields will have moved out a little further. But I say that carefully, a little further, not the same degrees by which we were seeing those movements at the end of last year. We are starting to see some stabilization in yields, which is also exciting news, because it might mean that we are also starting to find that pricing, that new pricing level. We're also starting to see more product coming to market, which is exciting as well, because it means that we're finally finding that closeness almost the same expectation between vendor and acquirer aspirations, but we are starting to see more signs of stabilization in the market around pricing, around expectations on pricing from both sides of the equation, and also more product being brought that will then give us more evidence to be able to say this is where we find our new level. It's not the same for every country, but I'm sure we'll talk about this in more detail. What is also exciting is that there is still plenty of conviction in the logistics and industrial sector. So on the left-hand side, this shows the dry powder of investment capital available in the market. And end of 2022 was a record volume of dry powder. We're talking about close to 270 billion, or over 260 billion euros of investment capital focused on European real estate. That's not specific to logistics, but it is specific to real estate and by character. And we are seeing far more of that capital focused on value add and opportunistic opportunities, and particularly around capturing reversion, which I'm sure we'll talk about on panel. But some of the fundamentals remain strong about asset location, around tenant covenant strength particularly, but also those future marketing lettability potential. Sustainability rising up the agenda. It's never not going to be part of the conversation when it comes to investment, but also, of course, and we'll come on to this, I'm sure, the access to and the cost of finance is ever more present in everyone's minds, particularly around that pricing point. But what really strikes me when talking to investor clients and my capital markets colleagues is how much is waiting in the wings, not just in terms of dry powder, but the conviction with which they have on the logistics sector. And all of that is banked into the fundamentals of the market. And that's structured around the occupier market position is still strong. It has slowed since we were in the COVID period where everything went extraordinarily strongly, shall we say, in terms of, I like to use the word bonkers, but it's quite a British term. But in terms of where we are now, we're still at above pre-COVID levels, albeit, we may level back out at pre-COVID levels, but that it was still a strong market position before we went into COVID. We are still in a constrained availability environment, which means that we are looking at pressure for the occupiers looking for space, and that is continuing to drive the rental growth story. On the left-hand side, our rental growth for the last 5 years, rents across Europe, which Raimund no doubt will be able to tell us the pain with which occupiers feel. Rents on average have gone up by 35% over the 5-year period on average, but as much as 85-90% in some key markets across Europe, including parts of London, Prague and Krakow. And on the right-hand side here, just as a final point as well to make on the conviction in the sector and the fundamentals still looking strong, this is showing confidence indicators for both businesses and consumers. And whilst there is still an awful lot of uncertainty, and there's still a lot of, if we read the news or listen to the news these days, it can be easy to be pessimistic. There is actually an awful lot of good news that is coming through. And the businesses, the confidence levels are starting to level out from their slide over the past few years. And we've started to see confidence levels rising quite markedly as well. So we see on the horizon green shoots, both in the market fundamentals, but also in the investment side, where we're starting to see some of those positive stories where we might be starting to find our new normal. As a market framer, I'm going to stop there and pass you back to Richard.
Super, great, thanks very much, Sally. Let's just do some. You've sort of introduced yourself rather fantastically there, Sally, so let's just move down the panel. Just brief introductions, literally who you are, what you do, so that then everybody knows who everybody is. We won't have time to go around everybody, but Raimund, let's start with you.
Hi everybody, does it work? My name is Raimund Paetzmann. I'm an independent advisor, so most people know me still from a long time with Amazon and Zalando, so almost 23 years in e-commerce, and now became an independent advisor and also doing a website, what I'm creating in the moment, Voice of the Occupier, because I think there's a lot of panels like here, investors would speak, some developers would speak, but the occupiers' needs are very often not heard. And I think it's very important. It's important for the investors that they make the right investments. And sorry, it's also a bit of the panel already that I'm also thinking it's sometimes interesting that you have actually an industry that has a very high value product and is doing so less research. And I'm sometimes really surprised. Everyone is product design. You invest so much money into what is actually required. And sometimes in real estate, there's just some we put the toe in the water and see what is actually going on, and then we do something. So that's what I'm trying to do to convey the voice of the occupier and bring in also this. Sometimes the occupiers can also not speak because they're also public listed. Of course, I will also not share now all the secrets what I hear from some others, but I think it's a very important part.
That's the only reason you're here, Raimund, is to share those secrets. Good, no, thank you for that, and that perspective will be very valuable. Frank.
Yeah, thank you. Yeah, good afternoon. My name is Frank Pörschke. I'm the CEO of P3 Logistic Parks. We are a leading developer and investor into logistics properties in 11 countries in Europe, and we are still active in the market, both buying and developing.
Simon.
Good afternoon, thank you. I'm Simon Walter, Executive Director, Investment Management at Verdion. We're a pan-European logistics investor, developer, asset manager. I sit on both the Verdion Executive Board and Investment Committee, and I work across all of our European markets, and I also oversee the asset management side of the business, working closely with all of our teams in the local markets.
Okay, great. And Frank as well.
Good afternoon, everyone. Patrick Frank is my name. I am in charge of GLP's business in Germany. So along with approximately 220 colleagues, we manage a total AUM of 17 million euros, 17 billion, excuse me, in Europe. And likewise, Frank said, we are present in 12 countries.
Great. And very interesting that we've got different perspectives across the panel here. You'll obviously be seeing a lot of the trends here across the area as well,
yes,
but can drill down a bit into Germany. So really interesting to get those. I wanted to just pick up on the start with the sort of, if we look at the key short and medium term trends that are driving the markets in Europe. So what do we see as the most important ones? And I guess how are they related then to the kind of fundamentals in terms of demand and those kinds of aspects? There's a lot of discussion about nearshoring, about whether e-commerce is pausing. What's happening there? What are the trends that you're seeing? Maybe let's start with you, Frank, if we can.
Yeah, well, I mean, at the end of the day, I think the most important question is how does demand hold up? And demand is holding up very well until now. And of course, we have these structural tailwinds which remain, which we all know about, so nearshoring, e-commerce, and reorganization of supply chains. But of course, ultimately, the business also depends on the general economic developments which we have. And currently, we are lucky enough to see that the structural trends dominate the more difficult economic environment. And this is pretty helpful because at the end of the day, if you have a tenant who pays the rent, you're doing well. And this is helping us as the asset class probably much better than other asset classes in real estate to go through the challenges which the capital markets have posed, having higher interest rates and as a consequence having expanded cap rates which have a negative impact on valuations. But of course, as long as valuations are kept up through the increase in rents, this is all good and stable, and this is fortunately the situation which we currently observe.
And Patrick, it would be interesting to get your perspective in terms of particularly the kind of German market as well.
Yeah, sure. Just building on what Frank just said. We come out of fantastic times, to be honest. We saw rent increases on a year-to-year basis by at least 10 to 15% continuously throughout the last 5 to 7 years, which is enormous for that particular asset class. So that was combined with a significant drop in yields. And now we see, well, as everyone is well aware, sort of a yield shift lifting us back to, well, I don't know whether it's normal times, but those really enthusiastic, crazy times, for the time being at least, are over. So when it comes to the tenants, though, you see, well, there is still potential for rental growth. There is for sure. But tenants are certainly way more demanding. Yeah, they're way more demanding when it comes to your building's fit out. when it comes to the sustainability aspect, certifications and whatnot. So from a development point of view, to maintain this rental growth, to maintain this rent level in general, you need to put in additional efforts, additional financial efforts.
Okay, good. I'll pick that up. If anybody on that side is having slight difficulty hearing, I can tell you for certain that if you're standing here, you will hear it perfectly. And I'm feeling a little bit lonely. So if anybody wants to come over here, honestly, you will be able to hear it significantly better, and nobody will worry that you cross over. But the sound coming into here is really, really much better. Trust me. So don't be shy. Come on over. Let's pick up a bit up in terms of the fundamentals. I mean, Sally was mentioning there about demand and supply. What are we seeing? And I'd be interested to get your perspective on this as well. But let's start with you, Simon. I guess, are we seeing constrained supply? What's your sense of that, and how might that be influencing the investment market?
Yeah, so we've have seen a slight increase in the supply and the vacancy rate. So clearly it got down to very low levels, around about 3%. That sort of seems to have moved up to around 4%. And we're still seeing a lot of leasing deals for the right assets in the right locations, and we're not seeing a substantial supply side reaction to it. So we still see that there's opportunity in those well-located markets.
Okay, good. Raimund, from your perspective, looking at some of the fundamental drivers, what's happening in terms of the occupier side? Are we expecting people to be still looking for space? Are they only looking for grade A space, fully sustainable? What's the position in terms of the demand side, I suppose, from the occupiers?
Of course, currently we all see it. There has slowed down the demand. There's no question. And especially, what I know most about e-commerce, it is also some systemic problem, because with exponential growth, and then with a very slow real estate market where you have to do the planning with 3 years ahead, so that means all the decisions for the building in the moment have been made 2020, 2021. So that means it's a logical oversupply in the moment, or you have an overcapacity. And of course, if you're someone like the super big one, Amazon, and you have 250 buildings, then it is some meaningful overcapacity. But as soon as it goes back, I think e-commerce or everything what is digital through to network effects, it cannot grow only 2%, so it will go double digit again. So I'm convinced that we need double of the space of what we have today. In 2020, 30, we probably need double of the space what is existing in Europe. And that means a lot. So they have to come back to the market. And you have nearshoring. You have actually in Germany the pharmacy program that they're just saying, we have a shortage of some medicines, so we have to store them in Germany, so this will be an extra pressure. So I would say Jeff Bezos said once, instead of focusing what is going to change, you should also focus your business model what is not going to change. And I think that's for certain. Demand will be there, and the supply will be not available. So if you're an investor long term, you have to do it. I would invest in buildings, because in 2025 probably everyone is coming and is looking for space again. So that, for me, it's really, I'm 100% convinced, of course, with a normal economy, if there's something crazy is happening or we are not recovering and the recession is going on.
Just to add to that, of course, there are cyclical trends, and we would expect that and as I said, when we look at the take-up position, it has slowed, but I use that word very measuredly, slowed, because the lengthening of the decision-making process has meant that the deals take longer to complete, so the demand has slowed down. And yes, there will be deals that haven't come to market yet, because businesses are thinking carefully about what their choices are in an environment of uncertain economic outlook. And yet, there is the pressure to renew stock. There is the pressure. There are also counter-cyclical pressures, counter-cyclical trends when it comes to logistics. Outsourcing your logistics operations to third-party logistics providers is more cost-efficient. And so that triggers a transaction. It might mean that it takes away from somewhere else, but it triggers a transaction for a third-party logistics provider to take space to house that position. It can also mean consolidation activities can also be more cost efficient, And so that again triggers a transaction for a new building that might necessarily mean a net absorption position, but it is a new transaction for a new building that's more efficient. And let's not forget the structural drivers like nearshoring, like e-commerce, but also sustainability goals that are driving businesses towards better quality buildings, or buildings that can deliver on a different range of fronts, not just the economics, but also their corporate aspirations as good corporate citizens. And they want to retain their customer base and their investors to be able to ensure that they have the right assets to be able to say they are doing the right thing. Yeah. So there are a number of other things that are continuing to drive that forward. On the supply side, we have started to see, and you saw on my chart, the availability rate starting to move out slightly, but we are certainly not expecting that to move out dramatically. Because we are starting to see the supply side response, and we are seeing developers choosing to slow some of their development. In plenty of markets, there's still a requirement to bring new product to market because the market is undersupplied, either undersupplied in total or undersupplied in good quality product. But we don't expect that availability rate to blow out dramatically. Because we are seeing that responsiveness from the development side. So that all goes into the health of the market when we come from the perspective of how does that look from a market balance position.
Maybe one thing, sorry to add, but it's also very awkward in real estate and every other industry. The market players would use this crisis saying, okay, now I can actually buy cheap stock, or I can do something and invest. But the problem is in the moment also that real estate is also super expensive. So even now going out, you say, okay, why should we make decisions now? We make decisions maybe next year, because still the construction prices costs are too high, and also of course the rents are high, and there is this hope, that's maybe going down again. Yeah.
But I think the key is what Sally has started talking when you said about the vacancy rate. The point where we start from, because with the vacancy rate which was below 3% and now is going 3 directionally to 4, which is a very healthy market, especially from the owner's point of view. And in the past, when it was not much more normal to have 5 to 10% vacancy in a balanced market, and now that we see that the transaction volumes on the leasing side have decreased, they're maybe driven by less demand, but this demand is hitting less supply, because first of all, from the existing stock, there's hardly anything available. Like for us, we have 98% occupancy. We can hardly offer anything from our portfolio. And then the new developments on the speculative side have gone back as well. So the lower transaction numbers may be driven not only by lower demand, but also by lower supply. And the fact that vacancy is only gradually going up a bit shows that we are still in a healthy environment. And simply, like Raimund, what you said with respect to the prices, yes, you're right. That means for a lot of developers, they cannot start speculatively. They don't get financing, construction prices are high, they have to be confident that rent levels have to be higher than today, because otherwise, with the cap rates of today, it doesn't make sense to do development. So only if this falls in place, someone has to pay for it. And ultimately, if the tenant doesn't pay for it, it will not going to happen. And that's the situation which we are in. And we continue to do speculative developments, and they lease up well within our business plan, because the tenants need the space, they have a focus on high quality space in the right locations, and it's a necessity for them doing their business.
I love it actually that it's always the reduction, and somebody said it before to me, it's always the occupier is always reduced. The only thing is we want to have low rents. Of course we want to have low rents, but this is not the big thing, and I was just talking about, it's clear, the economics tell you that the rent has to be higher, but it's just other than in every other market, because if you have a shortage in demand, the prices go down. And that's what I'm saying. So there's not this normal reaction that you said, now I can use the market and buy, because with low demand you have also low prices. It's the opposite.
Simon and Patrick, it'd be good to get your perspective.
Absolutely. So, we're talking about a 4% vacancy rate, but that's across the whole of the piece. So, if you break that down on sort of the older redundant space, then actually the supply of new assets is much lower, and therefore, structural vacancy coming out of that it is much lower. And I'm sure we'll talk about rental levels in a bit, but the type of space that occupiers are wanting, investors are wanting in terms of the product, is a completely different building than it was 10 or 15 years ago. I mean, a much higher grade insulation. We're looking at PV panels on all of the roofs, and it's a different building. So yes, the rents are going to be higher, but the demand is there for that new product.
And Patrick, it'd be good to get your
view on vacancy rates. Yeah, sure. We see currently take-ups coming down a little bit in those really important markets in Europe. That's for sure. However, one aspect that we should not forget about is the fact that there is a grey market sort of developing. Subleasing is becoming, well, I don't want to say famous, but it's a common thing now. That long-term leases now being converted into sublease construction. So that is also a very huge competition for new take-ups, and that is something that I would see as a new phenomenon going forward.
Okay, good. And in terms of the pricing side, Patrick, what are you seeing there? I mean, do you see that stabilizing? Do you see it? When we're looking forward, how do you see that playing out?
Well, when talking about cap rates or talking about rents, I see, to be honest, when it comes to cap rates, I still see, in combination with the dynamics we see in rental growth, that markets are somewhat bottoming out. This I would expect. Again, this is my view, and not necessarily everyone on this panel shares it. That we see now a motion that it's going to be sideways for quite a while. So prime yields then in Europe, when talking really about firm numbers, would be probably something between 4.15 and 4.50 net. That's what we're going to see. But the first time we see a phenomenon these days is that between the B product, so-called, and the A product, there's going to be a significant discount. That's what I'm going to expect. So secondary locations, that's also been a phenomenon in the high times, that actually the weaknesses of B locations, price-wise, have been almost ignored, giving this massive pressure from the tenant side. So, and again, of course, if a building does not perfectly tick all the boxes when it comes to sustainability, you see also for the very first time a significant discount on valuations, which is interesting. Yeah.
So that's in the German market. You're actually seeing a discount now in terms of valuation.
Yeah, let's pretend by now that German is one of the important markets.
Yes, no. I mean, but you're specifically seeing it here. Because it's interesting, because I'm not sure we're seeing it necessarily translated into the others, but it'd be interesting to get Frank and Simon's view on that as well.
Yeah, so I think we are starting to see that now. I mean, I think the conversations that we're having with investors and assets in the market, that is one of the first questions that's been asked, and we will definitely see a discount for those assets. To reflect what needs to be done to the buildings to improve them. I mean, obviously, location is another thing, but just in terms of the quality of the building.
And
I mean, since last year, it's obvious that there's an impact on valuation. Yeah? So, and we saw it in our portfolio, that we saw the cap rate expansion coming in, but again, counterbalanced partially by the rent increase, which means by the end of last year, we had 2 point something like-for-like devaluation impact. We have seen similar levels for the first half of this year. Do we know how this will continue? If you tell me how the interest rate level will be in 6 and 12 months from now, I'll tell you the impact on valuation. But we assume that, I mean, you can make money on cap rate compression, on rent increases. We believe that the balance will be positive. How these two factors will contribute, this is supposed to be seen, but at least if let's assume for a moment that cap rates will be stable, that means that valuations will be stable in that dimension, then they will go up because of the rent increases. And if you miss out now, then you may have 5% higher rents in 12 months, or maybe 10%, depending on which markets we are in, and then you have missed the opportunity. So can we be sure? No, but at least we have shown in the last 12 months almost that we believe that the balance will be positive.
And does this mean, and I'll pick that point up with you, Sally, does this mean that there's more of a focus now on the sort of value add type of investment because there's capex to be done on on assets to bring them up to the market that's the standard that's needed in the market? What's your sense of that?
Yeah, I would feel that the biggest bid-ask spread is on very core-ish stuff. So that's just, I mean, if you finance 2 years ago at below 2%, and now your financing cost is above 5%, which means someone expects you to come in with a negative leverage at the beginning, you have to really seriously believe in rent reversion, which better comes soon than late, in order to make such an investment decision. Yeah? So which means that's a practical consequence. Then it's easier to find a compromise on a deal which is more, well, this has the title value add, which means you have positive yield already from the start, and then you grab some reversion, which is possible because of the past rent growth, which was not always translated in actual higher rent, depending on the market. I mean, in the UK, it traditionally comes only every 5 years. In the other markets, indexation was below rent growth, yeah? So which means there is a catch-up, which is still possible.
Yes,
yeah, go ahead.
Just to sort of add to that, so I mean, if you look at the stock across Europe, I think around about 50% of the stock is 15 years or older. So that means that there's a huge amount of assets out there that have scope for improvement, so value add. What we're also seeing is a number of sort of underutilized sites. And being able to bring those forward. So, for example, we're taking assets in our value add fund, typically a site coverage of 30, and then as well as remodeling an existing building, we're able to extend that building and push the site coverage on to sort of 50%. So we can see additional value to be created from older assets.
And Patrick, it'd be interesting to get your perspective on that. And also, I guess, are we still seeing a lot of, Sally mentioned the dry powder. Yeah. Are we still seeing logistics as that sort of attractive one in terms of the institutional capital?
Well, I'd say clearly yes, because we still have a story to tell. Yeah, we still have the story as lined out already about strong demands and good fundamentals. For me, just to round this up, value add for me is the new core. And when I talk about value add, and by the way, this is exactly what investors these days are looking for, to be in the position still to use sort of a leverage effect. Buying in at 4.5 and financing at 5 does not make necessarily too much of sense, right? And this is why markets are slowing down. However, when you tackle a building at a more like 6-7% on European level, and being in a position to extend, to develop, to work on the lease, to manage, to green. This is also a very big thing for the time being. This is where the actual value is, because again, bringing an example in Germany, zoning is extremely difficult and challenging and takes ages, and I would say is an IRR killing factor to some extent, because there's such a massive time delay. However, buying into a value add existing fully zoned asset helps you just to bypass a lot of problems with municipalities. So yes, value add is the new core.
Okay, I like that. That's good. And in terms of in terms of the speculative development side, presumably that's not going to work with financing now. So therefore, that's mainly for all equity. What's the situation there? And I guess are other players who maybe aren't specifically focused on logistics now beginning to be slightly out of the market, and it's more focused on the specialists who've been doing this for some years? What's your sense of that?
Yeah, so I'll take that one. No, we obviously the debt markets have changed considerably, and actually employing leverage on speculative developments, whilst you can get the finance from a risk-adjusted basis, we think that we're funding development of equity, and then looking to leverage on stabilisation. I agree. It's there's a lot of opportunity out there if you can create value. So I think it's time for the specialist. We have technical expertise in all of our markets. So the team is sort of vertically integrated to really help us to execute that strategy.
And does that also support? I mean, because there's less transactions in the market, obviously, across the piece, not just in logistics. Are you then are you finding niches? Are you finding investment opportunities? Obviously, on the newsline, we're tracking what's coming through, so I know that you are. But what's driving that? And what are you finding in the market at the moment? So, who's selling? Where are the opportunities?
Yeah, I mean, it is hard to source the opportunities, and you really need to be creative when you're looking at individual sites. Where possible, and we try to acquire off market where we can really review the asset, understand the business plan, and be able to carry out our proper due diligence. I mean, I think there are opportunities out there. I think there are a number of owners of assets that would look to exit some of their where they can't execute the business plan themselves. So no, I mean, as a specialist, we are seeing opportunity out there in the market.
I was just going to volunteer that from our perspective, working across markets and across EMEA, that there is certainly still an appetite for single let assets, where you have the knowability of that rather than portfolios, or small portfolios where there is, and crucially in nearly every dialogue, is reversionary capture potential. So the ability to be able to capture the exciting rental growth that is being witnessed in the market from an investment perspective, sorry, Rem, but from the investment perspective, the reversionary capture is really important. But I think crucially, it's not just about transactions that we've seen in the past, like a single asset or a portfolio, or it's about scrutiny around that and due diligence to understand what they represent in terms of that potential, but also perhaps more creative deals, looking at opportunities on not necessarily cross-border, but looking at larger platform positions where there may be an opportunity to be able to enter a market where there are reasons to go into places where you're able to find an opportunity, maybe a merger and acquisition deal. We are seeing more appetite for creative deals where there is not the traditional route, but because the pricing position has shifted from where we were a year and a half ago, it creates an interesting opportunity, particularly where you're well capitalized to be able to realize that. And I think the time is now. There is very nearly, we are at that point where we will see that pricing stabilization across geographies. And so we are now at that point where the time is ready to be able to seize the great potential of what logistics and industrial, particularly with all that tailwind behind us on the fundamental side. It's around the pricing. And once we get to that pricing point, it will be a new normal in terms of what that means for investors and how they're able to enter the logistics and industrial market, where they might have not been active over the past few quarters, year and a half. We're coming to that point now where I'm expecting to see transactional activity really engage, because it is getting to that exciting point where it is a buy time.
So we have acquired around 800,000 square meters of GLA year to date from a different selection of sellers. So listed players, funds which were coming to their end of life, development funds, another listed player who wanted to deleverage. None of these transactions were really forced, or they were all, well, in a civilized way in that sense, yeah. So between a willing seller and a willing buyer, so we didn't see any disruption really in that market, because it was good product and of course it made sense for us. So if this continues, then this is certainly much better than it used to be. but it's not where you can bargain hunt in that sense. And in contrary to that, on the development side, when we buy land, this is difficult because land prices have not consistently decreased to the extent as they should have. When you look at the changes in the market, but if there's no pressure on sellers, which there was in the financial crisis when the landowners were all highly leveraged, this time they are not. So which means some of them sit on their hands and say, okay, if I don't sell now, I may sell in 2 or 3 years, and that limits opportunities. Still, we manage to find enough and then entry into the deals very early, before sometimes years before construction starts, and help to develop the land and get the zoning, which is a challenge, especially in Western Europe.
Good. It would be interesting I know we're hard up against our time here, but I just wanted to pick up something on locations, just in terms of where you see the opportunities at the moment. Maybe Raimund, just starting with you in terms of the supply chains briefly, and whether or not there's anything driving either, we're seeing more, I guess, shipping, transportation. Does that encourage us to believe there'll be something else happening closer to Italy or to the Mediterranean, for example? Other things that are driving some of the locations, and then I'd be interested to hear other people's views as well.
I think the point is a little bit, of course, they're the perfect locations. The problem is also the perfect locations are in high demand. So in the moment I see it, it's almost hard to believe, and the supply chain guys, they don't like it, but I always feel that we have to adjust their supply chains according to locations, because that's, if there is the location is not available and the labor is not available, you have to adapt somehow, and that means probably you have to adjust this entire supply chains. And of course it's a big thing. It also has an impact on other buildings, but it means maybe that also B location become more attractive. So there's definitely a trend that you have to find something, but also I cannot stop to make a comment about, there's always 3 parties involved in, doing buildings, and I'm in Amazon. I think I introduced, not the first one, but I think heavily introduced the open book principle, so I know a lot how it's calculated. So there's the yield, there's also the developer, and there's the occupier. And I think one thing is also what you should see, the developer margins, they have been insane for a certain period. It's good, everyone should make his money, but that's my point sometimes when I'm talking about high rents. It cannot happen now that everything stays the same and the occupier is paying it. So that's my view. I think everyone has to recalibrate a little bit and saying, I know it's not crazy anymore, it's even hard. But it's also depending what is the risk level. Sometimes, when we had discussions and we did a build to suit, then I was wondering why at the beginning there were companies that were asking for 20% developer margin. Say, why do you want to have a 20% developer margin? You have actually a tenant in the moment we start the building, I sign the contract, you have everything, so we create the income. Why should it be 20%? But the opposite, if somebody is taking a risk, for example, if somebody is starting now to develop and saying, I have all the permitting and everything ready, then even my occupier head, I would say, okay, rightly done. You have done this research, you have taken a risk, then it's also finer to have a higher margin. And I'm not bashing you now in the developer, it's all okay, it was just a market trend. But just in the moment when everything is switching, I just want to make this point as well, that's also important, that there is a healthy environment, because overall, the rents and the transportation, because the logistics is a big part of our society, and if the logistics is increasing, so the prices will raise, and that's it for the entire economy. So I think there has to be a healthy development. Also the construction companies, I think also the construction companies started to, every year I want to have more from the cake, a little bit more cream on it. And that's something, we all have to come back in a setup where we think a little bit more prudent, and say, well, we have to be a little bit more careful. And I think now is the time also for the location, and that's also a good opportunity for developers or investors to do it, because otherwise you don't have it. If the market is coming back, then you don't have the location, and now you should basically do it.
Okay, good. Patrick, locations, what's your take on that?
Well, yeah, I still truly believe in Western European markets providing a super high level of stability for the time being. In particular, I see still opportunities in those very big conurbations. So this is actually where you should sit in as an asset manager or developer.
Okay, good. Simon?
Yeah, absolutely. We're focused on locations, and there's still strong occupier demand there. I mean, we've just started a project in the south of Berlin where we're speculatively developing 62,000 square meters. We've launched the marketing a couple of months ago, and we're talking to tenants on 70% of the space. So, I mean, we've really focused on that location, and then you'll see the demand coming.
Okay, good. Frank, growth locations?
Yeah, so we are balanced. We have 60% of our business in Western and Southern Europe, 40% in CEE. The strongest rent growth recently was in Czech Republic and Poland. But aside from that, we focus on countries like Germany, Netherlands, France, Italy, Spain. So basically all our markets are on green, and we are happy to do things on a risk-adjusted basis.
Okay, good. And briefly, Sally, just in terms of nearshoring, those kinds of things, does that mean that there's going to be more opportunities, not just in Poland, but also in Romania, Bulgaria, those kinds of geographies that maybe investors haven't necessarily looked at before?
I mean, certainly nearshoring represents opportunities to expand into new geographies where there may be a more attractive return opportunity because they are, higher yield, but there is a way to do that, whereby you're partnering with the occupier to create value across the entire transaction. For the occupier who is thinking, we would like to be able to nearshore to a geography where we're currently don't have a facility, working with the development or a capital partner they have a relationship with is a really attractive way to be able to create that opportunity in new geographies where it unlocks the opportunity for the occupier, but it also de-risks in part, certainly, for the capital or the development partner to go into a new geography with a higher return rate. I think it's an interesting dynamic because it's not only going to be about new geographies or lower cost geographies like the Central and Eastern European countries or the Southern European states, but actually nearshoring is going to be something that gives to a lot of geographies, including established countries like Germany, like France, like Italy, the Netherlands, where there are good, compelling reasons to take investment for new manufacturing facilities from the occupational perspective and create and unlock those real estate opportunities that brings. It is different for different sectors, it is different for different reasons, and it's not all about cost. And it does mean that we're going to see it more widely spread across countries. I would love to be able to say exactly where, but I think that's up to you guys to be able to unlock those opportunities for the occupier to be able to find the places that they're going to put their money.
Thanks very much to everybody for being here. We've got the next session will be at 5 o'clock, which is focused on alternatives. So and then there will be drinks immediately after that. So, which is an alternative to everything else. Thanks very much for being here. Thanks very much to the speakers.